D.R. Horton, America's largest home builder, just wiped $2.8 billion off its market value in a single day. But the real story isn't just in their earnings report. It's in the details most media outlets completely missed. In a 45-minute earnings call, D.R. Horton CEO revealed that new home orders had plunged 38% in key markets. What scared investors wasn't just the drop in orders. It was the company's desperate attempts to move inventory. For the first time in D.R. Horton's 44-year history, they're offering unprecedented incentives across all price points, from starter homes to luxury properties. Their cancellation rate has jumped to 27%, meaning more than 1 in 4 buyers is walking away from contracts. This is happening despite the builder offering to buy down mortgage rates by up to 3 percentage points, a cost of roughly $40,000 per home, coming directly out of their profits. The market's reaction was swift. Within hours of the earnings call, D.R. Horton stock plummeted 11%. The entire home builder sector lost over $7.4 billion in market value. Trading volume spiked to 6 times the daily average, and Wall Street issued 7 downgrade warnings. The warning signs aren't isolated. In the last 30 days alone, new home inventory has surged 97% in D.R. Horton's primary markets. Price reductions are appearing on 42% of new listings. Construction companies have laid off 27,000 workers, and major land acquisitions across the Sun Belt have been halted. The last time we saw similar signals was in early 2007, just months before the housing market began its historic collapse. In Texas, D.R. Horton's biggest market, new listings in Dallas have surged 112% compared to last year, while median prices dropped 5.2% in just 90 days. Austin's inventory has skyrocketed 143%, not a typo. Homes that sold in 48 hours last year are now sitting on the market for an average of 97 days. Builder confidence has dropped to levels not seen since 2009. In Houston, cancellations have jumped 47% across every price range. This isn't just entry-level buyers walking away. A prominent Houston developer recently halted construction on a 200-home master plan community, citing unprecedented market uncertainty. Florida is sending equally alarming signals. In Tampa, new home inventory is up 78%, and builders are outbidding each other on incentives. One major builder is offering a 4.99% rate lock for the full 30-year mortgage term, essentially paying hundreds of thousands per home in buy-down costs just to move inventory. In Orlando, price reductions are appearing on 42% of listings with an average cut of $42,000, and some builders are reducing prices 3 or 4 times before finding a buyer. Jacksonville builders are offering average incentives of $42,000 per home on a $400,000 property where typical profit is $40,000. They're giving away their entire margin just to avoid sitting on inventory. In Atlanta, institutional buyers who made up 32% of purchases in 2022 have virtually disappeared. Invitation Homes and American Homes for Rent, aggressive purchasers just a month ago, have completely halted their buying programs. Investor purchases are down 68% year over year. What builders are offering right now goes far beyond typical seasonal incentives. D.R. Horton is providing a 3% mortgage rate buydown, roughly $42,000 per home, plus $25,000 in closing cost assistance and up to $75,000 in premium lot discounts. One D.R. Horton sales office in Phoenix is even throwing in luxury car leases for buyers who close within 30 days. Lennar, America's second largest builder, just launched what they're calling their Whatever It Takes program, offering to buy down rates to 5.99% for the full 30-year term, a cost that could exceed $100,000 per home over the life of the loan. Total incentive packages on some million-dollar homes now exceed $200,000. Builders are giving up nearly their entire profit margin just to move inventory. Meanwhile, nationwide completed but unsold homes have increased 128% in the last year. Builders are also sitting on what insiders call shadow inventory, homes left 95% complete without final fixtures or flooring installed. To avoid counting them as standing inventory while existing stock gets cleared, A former VP of construction at a top 5 builder estimates there are over 100,000 homes in this shadow category nationwide. The supply chain impact is significant. Lumber orders are down 42% year over year. Window manufacturers report a 35% decline in builder orders. Appliance manufacturers are seeing a 28% reduction, and flooring companies report a 31% drop in builder business. D.R. Horton alone has over $9 billion in land purchased at peak 2021 and 2022 prices, now sitting on their books. Understanding the market psychology is crucial for anyone involved in real estate right now. 18 months ago, buyers were entering bidding wars and offering $50,000 over asking. Today, we're seeing the complete opposite. A potential buyer in Austin recently put plainly, "Why buy today when the builder might drop prices again next month? The bigger the incentives get, the more worried I become about buying too soon." This wait-and-see mentality creates a negative feedback loop. Rising inventory forces bigger incentives. Bigger incentives signal that prices are negotiable, so buyers wait. Waiting causes inventory to build further, forcing even bigger incentives. The cycle tightens. In Phoenix, a KB home community sold homes for an average of $585,000 in January. Identical floor plans are now being offered at $499,000, with another $40,000 in incentives, a real price reduction of $126,000 in under a year. In Las Vegas, one major builder sold a model home for $680,000 in September, then listed an identical floor plan next door for $589,000, creating instant negative equity for their previous buyer. Every discounted new home creates a comparable sale that drives down values across the entire neighborhood. A recent survey of 1,000 real estate agents revealed that 72% report buyers are explicitly waiting for lower prices. 84% say buyers are demanding incentives equal to what builders offer. 91% believe current home prices are unsustainable, and 68% are advising buyers to negotiate aggressively. Competitive undercutting between builders is creating what industry veterans call a race to the bottom. When D.R. Horton offers a 3% rate buydown, lender counters with 3.25%. When Toll Brothers offers $50,000 in design credits, KB Home responds with $60,000. This isn't just another housing cycle. The structure of this crisis is fundamentally different from 2008, and in several ways more concerning. In 2008, the crisis was a subprime mortgage problem. People who couldn't afford homes were given loans they should never have qualified for. Today, we're facing an affordability crisis combined with an inventory glut. In 2008, the median home price was $196,600 with average rates around 6%, creating a monthly payment of roughly $1,180. Today, median prices sit at $431,000 with rates at 6.9%, creating monthly payments of $2,850, a 142% increase in monthly costs, while median household incomes have risen only about 4% over the same period. In 2008, builder inventory took nearly 2 years to reach critical levels. This time, we've seen a 97% inventory surge in just 9 months. During the 2008 crisis, D.R. Horton's worst quarterly cancellation rate peaked at 33%. We're already at 27% despite far larger incentives, and we haven't hit the peak of this cycle yet. The financing environment is dramatically different too. In 2008, predatory lending and exotic mortgage products were the problem. Today, the opposite is true. Extremely stringent lending standards combined with the highest mortgage rates in 23 years mean there's no easy fix through lending policy changes. In 2008, the Federal Reserve had room to cut rates from 5.25% to near zero to stimulate the market. Perhaps most concerning is the scale of potential losses. In 2008, the total value of the U.S. housing market was roughly $22 trillion. Today, it's over $47 trillion. A 20% decline today would wipe out nearly $10 trillion in household wealth, more than twice the total wealth destroyed in 2008. And unlike 2008, where the crisis was concentrated in California, Florida, Arizona, and Nevada, today we're seeing synchronized weakness across almost all major markets simultaneously. The very cities that led the post-pandemic boom, Austin, Phoenix, Tampa, and Nashville, are now seeing the fastest inventory buildups and steepest price declines. What we're witnessing isn't just another market cycle. It's a fundamental reshaping of the housing market driven by a combination of factors that have never existed together before. Record high home prices, record high mortgage rates, a massive inventory buildup, disappearing investor demand, builder price wars, limited Fed intervention options, and global economic uncertainty. Unlike 2008's sudden crash, this looks more like a controlled demolition, builders and sellers gradually lowering prices until they find a level where buyers can and will participate again. Every incentive package forces competing builders to match or exceed it, creating a self-reinforcing cycle of price declines with no clear floor in sight. The warning signs from D.R. Horton are just the beginning. The question isn't whether this market is shifting. It already has. The question is how far it goes, and whether you understand it well enough to position yourself accordingly before the next phase arrives.